Cathie Wood's funds experienced a significant surge of 25% or more at the beginning of this year. Specifically, the ARK Invest Flagship Innovation Fund has seen an impressive increase of over 35% in just the past few weeks. While the general attention is on inflation, Cathie Wood has been actively investing billions of dollars in innovation. However, the question arises, is this a secure and reliable investment, or are the ARK Invest funds too focused on the distant future to navigate the challenges of the present? Hey, welcome to Stock Market Mate. Today we'll talk about Cathie Wood and ARK Invest's prediction on the rise of AI stocks. If you want to know more about that, then stick till the end of this video. However, before we start, do give us a like and subscribe to the channel to help us beat the YouTube algorithm. Innovation is the process of improving methods to meet people's needs. Disruptive innovation happens when a company provides significantly more value than its competitors, gaining a larger market share. For example, renting and returning movies used to require visiting a physical store and dealing with late fees. However, streaming innovation has revolutionized this experience by allowing movies to be accessed conveniently from home, offering a smoother and more cost-effective solution for customers. Streaming is just one aspect of a broader innovation that combines various technologies to deliver enhanced value. Competitors who couldn't keep up with these advancements face disruption. Today, companies in our investment portfolios are actively exploring new approaches to deliver even greater value to customers. ARK Invest's funds, such as the Genomic Revolution Fund, Autonomous Technology and Robotics Fund, Next Generation Internet Fund, and FinTech Innovation Fund have all experienced significant increases in value. There is a notable pattern emerging. Despite having different themes and stocks, these funds show a high level of correlation in their price movements. The correlation is a result of ARK Invest's strategy of including companies that reinvest their revenues into growth, which leads to lower reported earnings. As a result, companies with lower earnings have faced negative impacts from both investors and trading algorithms. This trend has become more pronounced since the Federal Reserve started raising interest rates. Higher interest rates increase the cost for companies to secure loans, which they rely on for investments in new assets, team expansion, and funding new projects. Consequently, growth companies find it increasingly challenging to expand, resulting in slower growth rates. As a consequence, investors should be willing to pay less for the stocks of such companies. However, there is a significant challenge in this situation. As interest rates rise, bond yields also increase. Bonds are generally considered safe investments. Consequently, when bond yields rise, growth stocks must perform even better to justify the risk associated with investing in them instead of higher-yielding bonds. This is why ARK Invest's funds exhibit such a high level of correlation, despite having different themes and containing companies from diverse markets such as Exact Sciences, Tesla, and Shopify. It is crucial to avoid investing solely in one type of asset, regardless of how enticing it may seem. Recent reports from Citibank and Deloitte highlight that fine art has one of the lowest correlations to stocks among major asset classes. Additionally, 85% of wealth managers believe that art should play a role in diversified portfolios. Moreover, contemporary art has more than doubled the returns of the S&P 500 over the past 26 years. This is where Masterworks comes into the picture. Masterworks.com is a unique platform that enables investors to diversify within multi-million-dollar paintings without breaking the bank. Their team of analysts identifies artists with the best risk-adjusted returns, acquires paintings by these artists, and registers the artwork with the SEC. They have secured over 200 paintings ranging from $500,000 to $25 million, and each painting must meet the SEC's criteria. These paintings are then securitized, allowing investors to add shares of these artworks to their portfolios. In the last 60 days alone, they have sold 3 paintings with returns of 10%, 13%, and 35% net to investors. It is important to note that past performance does not guarantee future results. However, in this type of market, these numbers are impressive. It is no surprise that Masterworks has attracted over 600,000 users, with some paintings selling out in less than an hour. Here's another important aspect shared by many of Cathie Wood's top stocks: the utilization of artificial intelligence, or AI, to address real-world problems. AI is a key technology driving innovations across various areas of our daily lives, including transportation, robotics, gene sequencing, cloud computing, social media, and gaming. AI is not meant to replace jobs, but rather to empower individuals who possess AI skills. AI and automation can significantly enhance the productivity of knowledge workers, potentially doubling their output. This means companies can achieve the same level of productivity with fewer hires. Consequently, ARK Invest predicts that organizations will heavily invest in AI software focused on automation and productivity in the next decade. In fact, ARK Invest estimated a 42% annual increase in spending on enterprise software of this kind for the next 10 years. All this AI software will require AI hardware, such as cloud services, supercomputers, and embedded AI accelerators and GPUs. ARK Invest projects that the enterprise hardware market supporting AI will grow by a factor of 100 during this decade. from $17 billion in 2021 to $1.7 trillion in 2030. This is why I've been emphasizing companies like Nvidia, AMD, Intel, TSMC, Amazon, and Microsoft, as they provide the necessary hardware infrastructure to support the rapid expansion of enterprise AI software. Despite AI's ongoing explosion, the stock market hasn't fully recognized its potential. In Cathie Wood's recent episode of In the Know, she points out a major mistake the market is making. Using a prominent tech company as an example will demonstrate how disruptive forces are affecting it. Last year was particularly challenging for technology, consumer discretionary, and consumer services sectors, especially for innovation-focused companies. There are various reasons behind the declines observed in different sectors. Consumer services such as Facebook and Netflix are facing disruption from platforms like TikTok, which has captured significant user attention. Additionally, these companies are more vulnerable to economic cycles, as advertising, a crucial revenue source, is often cut during recessions. The decline in advertising, which occurred due to the recession starting early last year, has affected their performance. On the other hand, stocks in innovation portfolios faced a challenging year for a different reason. These stocks were penalized because they were investing aggressively for future growth. However, it is important to note that companies that are currently spending aggressively, especially in the realm of artificial intelligence, have a higher chance of becoming winners in winner-takes-most categories. While aggressive investment in innovation is desirable, the market often prioritizes short-term profits and dividends, leading algorithms to treat these stocks unfavorably without making distinctions. As a result, there is evident capitulation across many stocks, indicating a lack of investor attention. It is astonishing that the market fails to account for any innovation, and worse, does not give companies the credit they deserve for their efforts. Innovation is not just a future prospect. It is already evident in the bull market for growth stocks. One area of significant innovation is artificial intelligence, or AI, which is delivering breakthroughs across various fields. For instance, ChatGPT, an AI program, is outperforming the national average in standardized tests, or SATs, and will continue to improve over time as machine programs learn and save programmers substantial time. AI is akin to the assembly line of industrial revolution and the current knowledge revolution. Several examples illustrate this point. Connected TV advertising performed well last year despite the notion that TV was becoming outdated. Social commerce is now taking market share from e-commerce. Electric vehicle sales rose by 49% in the United States, while total auto sales declined by 8%. Autonomous mobility is expanding, with cruise automation expanding to Austin and Phoenix after perfecting their technology in San Francisco. We are already in a prime time of innovation. The next 5 to 10 years are expected to be remarkable. However, the market is currently undervaluing innovation, similar to how it undervalued value stocks in the late 90s, with investors solely focused on short-term profits and dividends. The companies disrupting established giants like Facebook and Netflix are not receiving due credit. Building a successful business with a competitive moat takes significant investments and expertise. Microsoft, for example, opted to acquire 49% of OpenAI instead of trying to build a comparable AI system themselves. Roku is outperforming Apple and Amazon in the connected TV market, even though it is considerably smaller by market capitalization. TikTok remains the most downloaded app globally, despite Instagram copying its features. Understanding technology is now as crucial to investing as understanding finances, which is why a focus on technology is essential. Using Netflix as an example, their goal is to serve users with engaging content that keeps them subscribed and generates profits. They achieve this through strategies like adding high-value content and employing recommendation algorithms. Netflix uses collaborative filtering and content filtering to make personalized recommendations. Understanding how these recommendation systems work is vital for investors to identify companies with superior user experiences and disruptive potential. TikTok's global success lies in its innovation recommender system called Monolith, which prioritizes fast learning and content delivery. This system quickly understands user preferences and provides relevant content from the moment users start using the app. In contrast, Netflix takes some time to familiarize itself with users' preferences. ByteDance, the parent company of TikTok, has opened up its suite of services, including the recommendation algorithm, for other businesses to leverage. This allows e-commerce platforms, music services, and video platforms to potentially disrupt established players like Amazon, Spotify, and YouTube by utilizing TikTok's recommendation technology. Overall, innovation is already driving significant changes across industries, and investors should pay attention to companies that are at the forefront of disruptive advancements in AI and other technologies. Well, that's about it for today's video. If you found this video informative and insightful, don't forget to give it a thumbs up and subscribe to our channel. Thank you for watching, and we'll see you on the next one.
If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!